Well, you guys want to talk about the difference between a Eurodollar futures contract and a forward rate agreement? I think that sounds like an exciting conversation to have, so let's go ahead and do it. Let's say that we enter into a contract here, and this contract applies to a rate that we want to realize here on the futures contract. Well, that's the same argument for the forward agreement. We enter into a forward agreement here for a rate that applies at some time period here. And if we assume that the rate, or the time period specified by the futures contract is the same time period specified by the forward agreement, and that we enter into these contracts at the same time, what would we expect the rate to be on the futures contract versus the forward rate agreement? At first glance, we might say, well, if it's the same rate for the same future time period entered into at the same time today, should they not be the same? Well, that's the question, right? The answer is no, they're not. They're not the same. So if they're not the same, they must be different for specific reasons. So our job is to find out, well, why are they not the same? And what is the relationship between the two, given how they're different? So the first thing that we can notice is, well, a futures contract is marked to market daily. You have daily settlement all the way through, whereas the forward contract is not. What does this mean analytically, numerically? Well, we'll get to that, but right now we're just identifying the differences so that we got it clear in our head what we're doing. Difference number one, mark to market versus no mark to market. There's our first difference. Our second difference deals with settlement, or what is called our final settlement. In the futures contract, the contract itself settles at time T1. That's settlement at time T1, and then a deposit is made and the market interest rate is paid upon that deposit. So, second difference is the final payoff, the final settlement from the futures contract, and we're going to specify the payoff as the market rate minus the futures rate, which if the market rate is above the futures rate, it's a positive payoff. If the market rate is below the futures rate, it's a negative payoff. So we don't have to worry about if it's greater than 0 or less than 0. This handles it all. There's the payoff. Well, the payoff for a forward rate agreement occurs at time T2. Market rate minus the forward rate. And you'll recall from Chapter 4, what we did was we simply just discounted it back to time T1 so that there could be settlement at T1, but the contract, the forward rate agreement, specifies settlement at T2. So there's our second difference, is a mismatch in the timing of final settlement. So let's see how we deal with each one of those two things. We'll deal with mark to market first, and we'll just rewrite our payoff so that we have it in front of us, the market rate minus the futures rate, which could be greater than or less than 0. And we're going to have a look at what happens when rates increase versus what happens when rates decrease. So let's say that it's Monday morning, the day is starting, and off we go, and we get to a point in time during the day, let's call it 2:30, where there's settlement. The market rate of interest will have either gone up or will have gone down during the day. Remember, this is mark to market daily, so if during a given day rates are up, well, look at the payoff, RM minus RF. If rates are higher, RF is fixed the moment we enter. If rates go higher, we have cash inflows. That's a positive payoff. Even if the market rate of interest is below the futures rate of interest and we're negative on the contract, during any given day, if RM ends up higher, it's a cash inflow regardless of what our cumulative position is. This incremental cash flow is going to be positive. But what's important to point out here is that we get cash when rates are up, when RM is higher. We will receive cash on any given day when the market interest rate is higher at the end of the day than it was at the beginning. So we're getting cash right when interest rates are higher. Well, that's good, isn't it? Well, what happens during a course of a day if the rates drop? Monday morning, we have our observation of what the rates were as of the close of Friday. Trading starts. Monday afternoon, it settles, and it's lower. well, that lowers our payoff, regardless if we're in a positive or negative position on the contract overall. On the day, we have a cash outflow. However, we are parting with cash. We part with cash specifically when the market rates are lower. So we're receiving cash, we're getting cash inflows when rates are going up, good, and we're parting with cash when rates are going down. We don't like to part with cash, but if we're going to part with cash, we'd rather do it at lower rates than higher rates. So we've got kind of an asymmetrical payoff. When we're getting cash, it's even better because it's at higher interest rates. When we're losing cash, it's not so bad because it's at lower interest rates. Well, that has a benefit for anyone who is mark to market versus somebody who isn't. So the futures rate that we observe on the futures contract will be slightly higher as a result. So let's see what that means. Here's our forward rate agreement. Here's our Eurodollar future contract. We're going to enter them at the same time. You'll recall that on the forward rate agreement, once we enter, it applies to a rate here. There's our RF. That's the rate that we will get. Our payoff will be RM minus RF. On the Eurodollar futures contract, we enter into an agreement to lock in a rate over here, which will be RF, but we said it will be slightly higher, so we're going to add a small premium, PR. RF plus PR. It will be slightly higher. So our payoff is going to be RM minus RF plus PR, which, if we expand it out, is RM minus RF minus PR. So let's have a look at what our payoff up here is. On the forward rate agreement, there's our payoff. On the Eurodollar futures agreement, there's our payoff. Notice that these two are identical, but the futures minus PR. So the payoff is going to be lower. The payoff on the futures dollar contract will be lower than the payoff on the forward rate agreement. And what we're doing here is we're assuming the forward rate agreement will settle at T1 along with the futures. We're just trying to isolate the impact of the mark to market because mark to market will have some benefit to us by having mark to market. It makes sense that we would have a lower payoff to compensate us for the higher benefit of having mark to market. So our conclusion here, therefore, for any RM at T1, our cumulative expected payoff for the Eurodollar futures contract will be lower. The cumulative expected payoff will be lower to reflect the fact that because there's a benefit that we're receiving, there will be a premium on the observed rate at this time, over here at this time, so that it will result in a lower payoff to balance the two. How much lower? We're going to find out. It depends on a few things. We're going to see what that is. So let's look at the second difference, which was just a difference in the timing of settlement. On a Eurodollar futures contract, it completely settles at T1. On a forward rate agreement, it settles at T2. And you'll recall in Chapter 4 when we pointed out that it settled at T2, we said we can always bring it back to T1 by discounting it by the market rate of interest over this period of time, which is, here it is, 1 plus RM over N. So all we're doing is we're taking the payoff at T2 and saying, well, what does it equal at T1? That's all. We're discounting it back to T1. But it doesn't take much to see that these two numbers are going to be different. This payoff is the full payoff, which is the same payoff at time T2, but if these two are equal, then by discounting it back to T1, they are no longer equal. So that the payoff on the Eurodollar futures contract, EDF, will always be greater than the payoff on the forward rate agreement because the forward rate agreement must be discounted. Now, we have to sort of make a distinction between, well, what if the payoff is positive versus what if the payoff is negative? Well, when the payoff is positive, when the market rate of interest is greater than the futures rate at settlement, the payoff will be positive. But that also means that interest rates will also be high. The payoff is positive. So what's happening here is that we're discounting when rates are high. So when the payoff is positive, we have to discount back when rates are high. It's not the discounting back is not the important point to remember here. The important point is that we're discounting back when rates are high. Okay, let's have a look at what happens when it's not a positive payoff, but a negative payoff. Well, time value of money says we want to receive dollars as soon as possible, and we want to part with dollars as late as possible. So, for the Eurodollar futures contract, if the contract works out, settles in such a way that the cumulative mark-to-markets is such that it's negative and we have to pay, well, we would rather pay at time T2, not T1. But if that's the case, the market rate must be lower than the futures rate, in which case that means we're paying out money when rates are low. So if we had, going to our last thing that we did here, when our payoff is positive, we took the payoff at time T2 and brought it backwards. If the payoff is negative, to equate these two payoffs together, we have to move this one forward in time. So let's do that. Well, RM minus RF, there's the negative payoff. We could have invested that payoff. Rather than parting with that money, we could have realized the market rate of interest over that period of time on that payoff, which that's what it is. It'll be greater than zero. So the opportunity cost of parting with money today is the market rate of interest over the period of time to equate it to the next payoff for the other contract. It'll be greater than zero. But here's the difference. We are moving money forward in time when rates are low. Now look at the difference between the two. When the payoff is positive, we have to move money backwards in time when rates are high. When the payoff is negative, we're moving money forward in time when rates are low. So there's another asymmetrical difference between the two. So the result is that the observed futures rate, when we look at the futures rate and the forward rate, the observed futures rate on the Eurodollar future contract will be slightly higher. Not a great as impact as the mark-to-market, but it still will be slightly higher, which again reduces that payoff because there'll be a premium on this. How much is that premium? How do we account for this? Let's do that now. So here is the formula we'll be using, or the derivation we'll be using. We want to equate the forward rate with the futures rate. And we said the futures rate will be higher because of the mark-to-market. There'll be a slight premium. And because of the timing difference in settlement, there'll be a slight premium. So whatever the futures rate is, we must deduct some adjustment from it. This is called a convexity adjustment. We must reduce it by some adjustment to get the forward rate. Now, the intuitiveness behind this is fairly straightforward. This is the main variable of interest right here. That's the one that pretty much helps us understand the whole thing. And this is the standard deviation of the change of short-term interest rates in 1 year. So it's an expectation of the standard deviation of the change in short-term interest rates in 1 year. If we expect that interest rates will be flat and constant for an extended period of time, like they have been over the last 5-6 years across most of the world, if we expect that standard deviation will be very, very close to zero. And in fact, let's go to the extreme case saying rates over the next 4 years are not going to change. The standard deviation over the next year is going to be zero. If that is going to be zero, this whole adjustment is zero. The forward rate equals the futures rate. If nothing changes, the forward rate will equal the futures rate because there's no variability. There's none at all. So daily settlement, mark to market, if we expect no change in rates, there'll be no cash inflows, no cash outflows. That's an extreme example to sort of give you an idea of, oh, okay, I start to get it now. So if interest rates are volatile, from day to day, there'll be cash inflows and cash outflows occurring all the time. that will start to really matter, won't it? Yes, it will. So the more volatility, the bigger the adjustment. All right? And then, of course, T1 here is the time to settlement of the Eurodollar futures contract. T2 is just the length of time, is typically 90 days or 1/4 of a year after T1. So let's see how we price this out. Let's say that we're entering into a Eurodollar futures contract that's 8 years out. So we're going to lock in a rate today that occurs in 8 years for 90 days, and the quote is at 94. And we have a variance measure of 0.0012 on the rate. So we need to solve this problem. Now, some of the things that we need to know on this, at the very bottom, notice what I wrote here. Both rates are done with continuous compounding, the futures rate and the forward rate. However, the futures quote that we have here implies a rate of 6%. Remember, this is 100 minus R, and R is 94, which means we have 6%. Now, this is with quarterly compounding. So if this is with quarterly compounding, we're going to have to turn it into continuous compounding somehow, right? So let's make a note of that. This is expressed quarterly. So therefore, it is the same as saying 1.5% per quarter. The other problem is it's on an actual 360. For continuous compounding, we're going to need something over 365, just so that you're aware. So we have two little adjustments to make here. But as far as the convexity adjustment goes, can we take care of that now? We certainly can, so why don't we just go ahead and take care of that now. We have 1/2 0.0012 squared. T is 8, and it's 90 days after, which is 8.25. And if we multiply that, we'll get 0.475. So we're going to adjust the futures rate downward by 0.475%. The danger that you run into here is assuming that it's 6 minus 0.475. This is fairly straightforward to get because you're just reading off the variables that are given to you. You can't solve it unless you have some estimate for your standard deviation, right? So this is easy to figure out. Here, careful. That is expressed quarterly on an actual 360. We need to turn it into continuous compounding on an actual 365. So let's make a note of we want continuous compounding, RC, on actual 365. So let's just remember or recall what our conversion formula was. RC, continuous compounding, equals M, the natural log of 1 plus Rm over N. Well, Rm over N, Rm is 6, N was the 4. We already know it's 1.5%. This is where it gets a little bit tricky on the M over here, is you just have to understand we want the 365 over our 90, as opposed to 90 over 360, which is what a Eurodollar futures contract is. We need to turn it into 365. So our M, we don't know how many times a year it is. Do not put 4. 4 is the 90 over 360. That's 90 over 360. Or sorry, 360 divided by 90. We're doing 365 divided by 90 to put it into continuous compounding. And of course, natural log of 1.015. And all we have to do is solve for that. We'll get 6.038%. So, if we observe in the Eurodollar futures contract, for this particular contract, a quote of 94, it implies 6% or 1.5% that we're locking in on that future 90-day period. The forward rate should equal, what should the forward rate equal? And the forward rate will then be the futures rate expressed with continuous compounding for the year, 6.038%, minus our convexity adjustment, assuming the a certain variability or volatility in the interest rate itself, 0.475%, will give us 5.563%. So when we observe, if we're looking at a timeline for this future period of time, T1 to T2, and we're looking at entering a contract today, on a Eurodollar futures contract, we'll see a quote of 6%. That's what we have at the 94. We'll see a quote of 6. 6% changed over to continuous compounding minus a convexity adjustment will tell us on a forward rate agreement we should expect to see 5.563% for the same period of time.